Hi, I'm Luke, and welcome to CashUnion.net. Let's talk a little about annual percentage rate and the real cost to you of taking a payday loan. APR is simply the abbreviation of the annual percentage rate. Simply, all it really is the stated interest rate charged on a loan divided by the number of days the loan is valid for. Interest rates on mortgages, credit cards, auto loans, and just about all long-term loans you'll get are expressed in terms of APR. Now, it's a useful metric to compare loans that are outstanding for at least 1 year. Let's walk through an example. If someone says, I'll charge you a 10% interest rate for 6 months, what does that mean in terms of APR? Well, 6 months on average is 180 days. You take 10% interest rate and you divide it by 180 days, that equals about 0.0556% interest per day. Now all you do is take that interest per day and multiply it by the number of days in a year, which is 360. And voila, there you have it. A 10% interest rate for 6 months equals a 20% APR. Let's try another example. What is the APR for a loan that charges 20% total interest for a 30-day loan? We know that the days equals 30. This is just the actual number of days the loan is valid. So we take the 20% interest rate and we calculate the daily interest rate charged. We do that by simply dividing 20% by the number of days the loan is valid for, in our case 30. That division equals 0.7%. We then annualize 0.7% to get an APR. Annualizing simply means we multiply the daily interest rate by the number of days in a year, which for the sake of the math we call 360. And there you go. You get 252% APR. You can use our calculators to see what your loan's APR is and play around with the formula to see what any loan costs, whether it's a payday loan, an auto loan, or a credit card loan. But don't be fooled. APR really doesn't tell the full story. APR is essentially the cost of credit should that loan be outstanding for 1 year. It is the interest rate you'd pay for the whole year if you didn't pay off the loan right when it was due. But remember, payday loans are usually valid for only 7 to 35 days and are meant to be paid immediately. So comparing the fees to what you'd pay for a loan for a whole year, 360 days, is a bit unfair. For that reason, we don't feel the APR metric is the best way to look at the cost of a payday loan. Instead, think of loan fees as the total cost of convenience for borrowing from your future paycheck. The real cost of a payday loan is around 10 to 25% of the loan balance over the course of 7 to 31 days. These rules will vary state by state. You should only take a payday loan if it is absolutely the right financial solution for you. We believe in your free will and your ability to make the right financial decision. Use our tools to learn more about these effective and convenient loan products and see if they work for your situation. Thanks for visiting CashUnion.net.